thing that we get into is bank statement loans. Now, these aren't as obscure as some of these others that we'll get into because bank statements always been kind of like the fallback. If you can't qualify with traditional finance or traditional income methods, then you might need to drop into alternative. And bank statements usually the first alternative that we see. So this slide kind of talks about who are these borrowers, like who can do this kind of thing. Typically, when we're doing bank statement loans, this is pretty much who we see. According to the latest figures released by the U.S. Bureau of Labor Statistics, almost 10 million people are self-employed in our country. I feel like that number is probably higher because 10 million against 350 million, I feel like I know a whole lot of business owners. So in my little anecdotal evidence here, that might even be higher. The rise of independent contractors has expanded the need for non-traditional loan models that help serve the self-employed. We can reach a larger market of borrowers when you offer bank statement mortgages and 1099 income loan mortgage options. So who do we see that are taking these bank statement programs? Contractors, whether it be your building construction type contractor or some other contractor in the less traditional sense of maybe you contract for different companies, maybe you run trucking and your contracts are different because you own different companies and you contract through different larger companies to move their stuff around. You know, whatever kind of contractor is a very popular bank statement borrower. A lot of realtors can qualify for bank statement programs. Accountants, retail store owners, truck drivers, your actual truck driver, not the trucker owner, not the owner of the trucking company, but the actual truck driver. A lot of those guys are paid 1099 because they are considered independent contractors because they bring their own truck. They're responsible for their own fuel, you know, all these different things. So why choose 1099 over W-2? Because you have full control over your taxes and your write-offs. Granted, you don't have anybody holding back taxes for you when you get paid bi-weekly or weekly. You lose access to any kind of insurance plans or anything like that. But W-2 versus 1099 is really that's a separate discussion. But a lot of truck drivers are 1099 and a lot of them write off every penny that they can to save the tax bill. Beauty, spa, salon, hairdressers, colorists, you know, things of that nature, nail techs, nail tech owners, nail shop owners, auto dealers, auto mechanics, and then just self-employed people in general. Those are the people that we see doing bank statement loans. Now, when we get into the business bank statements, we are looking for 12 or 24 months of business bank statements only. So what that means is we have to literally get 12 months is going to be a little higher priced than the 24, but they're not wildly different. It might be a quarter point in rate. So if you can't produce 24 and you can produce 12, it's not the end of the world. But we literally have to get every single page of a bank statement from a borrower going back 12 to 24 months in the business name. So in our line of work, a lot of people just want to send us the bare minimum. They want to send us screenshots. They want to send us transaction histories and stuff like that. I hate to tell them, but we're sorry. We can't accept that. We need a full downloadable, emailed, printed, whatever, full page, all pages, bank statements with the business name and the address and the account number and all pages of the bank statement. So it's very document intensive, lots of documents flying around in these. But the whole reason for this is the fact that you cannot qualify for a loan with your tax returns traditionally or your whatever other way that we're trying to qualify you, W-2, paychecks, whatever it is. So this 12 or 24 month record of bank statements is going to show us that your income is X amount. So if you're collecting $20,000 a month average over 12 months, we can typically take 50% of that and make that be your monthly income. So we account for expenses, we account for taxes, we account for all that stuff. That's why that big 50% haircut is there to be able to show that you make enough money to afford this. You just can't show it on your taxes. So what are some of the keys of this bank statement program? So it's up to 90% LTV. So 10% down payment. We can go up to $3 million in this, minimum of 150. Foreclosure, short sale, or deed in lieu is not allowed on this program. So they will not fit in here. If they've ever had a big hiccup like that with property in the past, that kicks them out of this particular bank statement program that I'm talking about. Now, we do have other bank statement programs that get a little bit more aggressive. excuse me, I cannot cover every single one of these. So I'm kind of taking our biggest and most popular bank statement program that we use, and I'm giving that kind of thing. Bankruptcies, discharged for 48 months with no delinquency since the discharge. So they have to be out of bankruptcy for 4 years with no bruises on their credit during that 4 year period. So very important there. 50% of their business bank statements, I mentioned that. Purchase and cash out or rate and term refi. Again, all loan types are available here. Loan scenarios, owner occupied and second homes. So this is for your owner occupants. The DSCR was for your investors. So this is for people that want to buy a home and live in it. Second home or primary, both the same. Absolutely no exceptions on the 2 year self-employment rule. So they have to have 24 months of bank statements. They have to, or 12 or 24 months of bank statements. But even if we do the 12-month program, we have to go and see via licensure date, LLC filing, business license application, whatever their start date is for their business, absolutely has to be 24 months or greater. Okay, credit scores starting at 660. Rates are for 30-year fixed. Companies with a lower expense factor will require a statement from a third-party CPA. For instance, if what an expense factor is like if you look at a building contractor and they're buying tons and tons of supplies and payroll and all kinds of stuff. That's why we hit them with 50%. That's why we give them 50% credit. If we have someone who makes a good amount of money, but who doesn't have a lot of overhead, let's talk about maybe I don't know, let's say an attorney, where they only have to pay for their office and maybe a little bit of staff, but they don't have tons of materials and supplies and gas and, other huge operating expenses. They just kind of have a low overhead. Then we get their CPA involved and we get them to show us, we can or cannot. This person has this expense ratio. So if they can justify that, then we're able to use that and give them a higher percentage. And for amortization, 40-year interest only is available for this, but you keep in mind that when you're interest only, you're not touching the principal whatsoever. You're just kind of stepping through the early stages of this loan with a lower payment. So this is considered, I call this a Band-Aid loan, because if you have a borrower who owns a business and writes everything off as much as they can, they're going to get stuck with a higher rate. They're going to probably be in the 10s on this type of loan when they could be in the 7s or high 6s on a conventional loan. So what they have to do is figure out with their CPA, if I get this loan today and I keep it for the next 2 to 3 years, how much is it going to cost me in interest to carry that loan during that time versus if I do my taxes properly and I claim enough income to be able to qualify to refinance this into a conventional loan to get back in the 6s or 7s in a couple years, what does my savings outlook in that situation look like compared to the fact that I had to hold this high rate? So this is not a loan to get into forever. It's a loan to get into short term and to understand that you should probably take the hit for a couple of years on your taxes to make sure that you can refi this into a conventional loan in the future. All depends on the individual situation, how they want to run this and how much it can save them. Maybe they don't want to ever claim enough money on their taxes because it's going to be so much money in a tax bill that it's going to not be worth it. They'll just pay the higher rate on it. Things to consider there. I'm not a financial planner. I don't get into the weeds on that with them. We can definitely show them amortization schedules and how much these loans will cost them on a 4-year, 3-year, 5-year basis or 30-year basis. But we're not here to make decisions for them and to tell them how to file their taxes. That's between them and their CPA and their management of their business.